So, you want to buy a home, your first home, or maybe you want to buy a second home, an investment property, or maybe you just want a better mortgage rate than what you currently have. All right, so you just want to refinance your mortgage. Well, there are many different factors that one needs to take into consideration when looking to purchase or refinance a home. Starting with, what is the location of that property? What is the size of that house? What is the real market value of this building? And most importantly, your affordability, which is basically how much money do you have? What does your steady income look like? What are the loans and debts you have? Out of all these various factors, affordability is definitely one of the biggest factors that a lender will look into when you apply for a mortgage. You need to understand how lenders check your affordability. The way you calculate your affordability might be very much different from how a lender determines your affordability. So, how does the lender determine a borrower's affordability? Well, out of many things, from the lender's perspective, affordability of a home buyer or a borrower simply translates into three important metrics or three important ratios expressed as percentage. Number one, LTV, loan to value ratio. 2, GDS, gross debt service. 3, TDS, total debt service. Let's look at our first metric, our first ratio, LTV. Loan to value ratio tells the amount of loan or the mortgage amount that you borrow in relation to the actual value of the property. As a calculation, LTV equals mortgage amount divided by the value of the house, both in dollar amounts, multiplied by 100. Let's look at a simple example. Let's say our borrower, Mr. Justin, has applied for a mortgage of $100,000 and the value of the property is $200,000. LTV is simply 100K divided by 200K, which is 0.5. When expressed as percentage, it is 50%. So essentially, what this tells is Mr. Justin taking a loan which is equal to 50% of the value of the house. For the other 50%, he's arranging his own money. He'll be having 50% equity in that house. So he comes across as a less risky borrower for the bank or the lender. Now if he defaults on the loan, he will lose all that 50% along with the house. Now let's say he wants to borrow 50K more. Now the LTV here will be 100K plus 50K divided by 200K. This comes out to be 75%. In this case, he will be having 25% of equity. So now if he defaults on the loan, he will lose 25% along with the house. So obviously, bank feels safe to lend to people who have more equity in the house, which means people who have a lesser LTV ratio. So consequently, less risky borrowers will be offered better mortgage rates. Anything above 80% LTV is considered high ratio mortgages. Usually, these kinds of borrowers will need to buy a mortgage insurance. I'm not getting into the nuances of first-time homebuyer privileges. As a general rule of thumb, it's better to have a considerable amount of down payment saved to end up with a lower LTV ratio for better mortgage deals. Now, let's go. Let's look into the second important ratio, GDS, which is short for gross debt service. This measures the percentage of your pre-tax income, your gross income that will be needed to pay your shelter cost, that is your housing cost, that you're liable for in any given term. The usual housing costs that you are liable for are principal portion of the mortgage payment, interest part of the mortgage payment, taxes on your property, heating cost, and if you are living in a condo, 50% of the condo fees. Lenders and banks are not worried about your home insurance payments, groceries, furniture cost, cleaning cost, etc. Those expenses are something which you need to keep in check as part of your personal finances. GDS calculation simply looks like this. First, you calculate the shelter cost, or generally called as PIT. So basically, shelter cost is equal to your mortgage payments, which is a combination of your principal and interest, and that is added to your property taxes. Then that again is added to your heating cost. Then you also add a 50% of your condo fee and you get your shelter cost. Now, GDS is simply your shelter cost divided by the gross income multiplied by 100. As per industry standards, you will qualify for a mortgage only if your GDS ratio is less than 39%. You can do that by either increasing your income or by decreasing the amount you borrow for your house. Alright, beautiful. So the next ratio that we need to know about is the TDS ratio. This is a very simple extension of GDS. It tells you the percentage of income needed to cover all your other loans and debts along with your shelter cost. When I say other loans and debts, it's your education loan payments, credit card balance payments, vehicle loan payments, and so on. These are all those payments when you don't pay your check or when you don't pay back, the lender will come running behind your house for recovery. Again, the lender does not take into consideration your stationery expenses, your car wash expenditure, car insurance payments, etc. They just consider your loan payments for this calculation. The calculation is simply an extension of your GDS equation. So GDS was shelter cost divided by your gross income multiplied by 100. Now in case of TDS, you add your other debts to shelter cost. So TDS is equal to shelter cost plus other debts. Now this number is divided with your gross income multiplied by 100 and expressed as a percentage. In case of TDS, as per industry standards, you'll qualify for a mortgage only if your TDS ratio is less than 44%. So, how do you do that? By either increasing your income or by decreasing the amount you borrow for your house and also keeping your other debts very low, preferably zero. Wonderful. So we all now know what LTVs, GDS and TDS ratios stand for, how to calculate these ratios, what is the significance of these ratios, how to keep them in control, keep them in check. If you have specific numbers that you want me to use, please do let me know. We can run those numbers and help other viewers learn from it. My dear friends, own your money, own your ratios, score the best mortgage deal. Own it with Rakesh.